Hi. Let's learn about what a credit default swap, CDS, is and how it works. A credit default swap is a financial derivative that allows an investor to swap or offset their credit risk with that of another investor. To swap the risk of default, the lender buys a CDS from another investor who agrees to reimburse them if the borrower defaults. Credit default swaps are derivative contracts that transfer the credit exposure of fixed income products, such as bonds or securitized debt, to another investor. For example, an investor may purchase a CDS to transfer the risk of a bond issuer defaulting on a loan to another investor who agrees to pay them in the event the debt issuer defaults on its obligation. The credit event is a trigger that causes the CDS buyer to settle the contract. Credit events are agreed upon when the CDS is purchased and are part of the contract. The majority of single-name CDSs are traded with the following credit events as triggers. CDSs do not necessarily need to cover the investment for its lifetime. For example, an investor can purchase a CDS with a 5-year term to protect their investment until a specific year when they believe the risks will fade. When a credit event occurs, the contract may be settled physically or by cash. In a physical settlement, sellers receive an actual bond from the buyer, while in a cash settlement, the seller is responsible for paying the buyer for losses. Credit default swaps are used as an insurance policy against a credit event on an underlying asset and for speculation, hedging, or arbitrage. Credit default swaps played a key role in the credit crisis that led to the Great Recession. Mortgage-backed securities and CDSs were used as insurance against mortgage defaults, contributing to the financial crisis. Credit default swaps were widely used during the European sovereign debt crisis, with investors purchasing sovereign bonds and CDSs to protect their capital in case countries defaulted. A credit event triggers a credit default swap, causing the CDS provider to pay the swap purchaser if the underlying investment, usually a loan, is subject to a credit event. Credit default swaps are not illegal, but they are regulated by the Securities and Exchange Commission and the Commodity Futures Trading Commission under the Dodd-Frank Act. Credit default swaps are beneficial for hedging risk, as investors use them to protect a bond from defaulting on its payments, and for speculation, as investors can bet on the credit quality of the reference entity. Credit default swaps were highly used in the past to reduce the risks of investing in mortgage-backed securities and fixed-income products, contributing to financial crises. While their trading has been reduced due to regulations, the global credit derivatives market has continued to grow. Here are 5 key takeaways. 1. A credit default swap, CDS, is a type of derivative that transfers the credit exposure of fixed income products. 2. In a credit default swap contract, the buyer pays an ongoing premium similar to the payments on an insurance policy. In exchange, the seller agrees to pay the security's value and interest payments if a default occurs. 3. In 2023, the estimated size of the U.S. CDS market was over $4.3 trillion. 4. Credit default swaps can be used for speculation, hedging, or as a form of arbitrage. 5. Credit default swaps played a role in both the 2008 Great Recession and the 2010 European sovereign debt crisis. Hope this would help. Thanks for watching.